The dream of living a quiet life, paid entirely by dividend, is more popular than ever. You see the headlines about companies paying out record dividend. You hear about legendary investors like Warren Buffett pouring money into Japanese stocks. It all seems so simple, right? Buy some shares, collect the dividend checks, and eventually quit your job or have enough money to live a comfortable, retired life when the time comes. But what if I told you that for most people, this dream is mathematically impossible? The truth is, the numbers are a lot harsher than you think, and they are traps that nobody talks about. We are going to break down the 4 reasons why most people in Japan who chase this dream will, unfortunately, fail, and what you can do to build a much more realistic and successful financial future. The first and biggest hurdle isn't some big market secret. It is just simple math. The dream of living off dividend runs into the wall of Japan. High cost of living and its low dividend yields. Let's say you want a reasonably comfortable life. Nothing fancy, just about 3.7 million yen a year before taxes. Now, let's look at the market. Even with the recent improvements, the average dividend yield for the Nikkei 225 index is only 2 to 2.5%. That's not terrible, but it creates a huge problem for your nest egg. To get 3.7 million yen a year from a 2.5% yield before tax, you'll need a portfolio of 148 million yen. 148 million. That is true even if you were to invest in some ETFs or mutual funds offering better return, such as the next fund Nikkei High Dividend Yield 50 ETF that we talked about in this video here, offering a 3.5% yield recently. In that case, you will still need 94.8 million yen. Even if you invested in well-known international ETFs like the ProShare S&P 500 Dividend Aristocrat ETF with a 2.12% yield, the Schwab US Dividend Equity ETF, well-known under the ticker SCHD with 3.97% yield, or the Vanguard Dividend Appreciation ETF, VIG at 1.79%, or even the MSCI Japan High Yield Dividend ETF at 2.55%. There's not much difference in dividend yield. So let's go back to numbers. 94.8 million yen at best, but more realistically, 148 million yen is what you need. How many people can actually save that much? The median annual income in Japan is about 3.96 million yen. After taxes, social security, and just living your life, there isn't a lot of money left for the average person on a typical salary to save. Building a 148 million yen portfolio on that typical salary would take decades of aggressive saving and perfect investing. You need to put at least 15% of your median salary every single month at 6%, which is the average return of the Japanese stock market from the age of 25 to 65, and you will end up with 94 million yen. Close with a 3.9% yield, but not even there with a 2.5% yield. And even if you are doing everything right, that 2.5% yield or 3.9% yield isn't guaranteed. Dividend yields change with stock prices, and worse, the companies can cut their dividends payment. When the economy hits a rough patch, the very companies you are counting on might slash their payout to save cash. All of a sudden, your 2.5% yield could drop to 1.5% or 1%, and your safe income stream is gone. The math behind the dividend-only dream is a lot more fragile than most people think. And just before we go to the next point, it would mean a lot to me if you could give this video a like. That would make it available to many more people and frankly, help us as well. Thank you so much, and let's go to the next point. The second reason for failure is the silent killer of returns: taxes. Outside of a special tax-free account, every single dividend you get is hit with a 20.315% tax. That might not sound like a huge number, right? But it's actually a massive drag that eats away at your money year after year. Let's go back to our 148 million yen portfolio. A 2.5% yield gives you 3.7 million yen in dividends. But wait, after the 20% tax, you're only left with about 2.9 million yen. To actually get your 3.7 million yen after tax, you need to earn almost 4.6 million yen in dividend before tax. At a 2.5% yield, your required portfolio size just jumped from 148 million to 185.7 million yen. The tax bill alone just added a 37 million yen goalpost shift. But what about NISA? I hear you ask. The Nippon Individual Savings Account is, hands down, one of the best tools for Japanese investors. Your investment can grow completely tax-free, but it's not a magic wand for the dividend investors. The NISA account has a lifetime contribution limit of 18 million yen. Now, 18 million yen growing tax-free is fantastic, but let's be real. Even if you max out your NISA and get a 2.5% yield inside it, that account will only generate 450,000 yen per year. It's a nice bonus, but you can't live on it. Now, in an ideal scenario, if you manage to fill up your NISA with 18 million very, very fast, and then it grows for 30 years, say from age 30 to 65, and get a 6% return all the time without any drawdown, then you will have 103 million yen on it, and that's tax-free. Then you switch it to have a dividend income from your investment at 2.5%, and you'll have 2.58 million yen a year tax-free. Pretty good, right? But you'll still be short by 1.1 million yen a year. The truth is, few people will max out their NISA so fast and so efficiently in their investing journey. So, the vast majority of your giant 185.7 million portfolio has to be a normal taxable account, getting hit with that 20% tax every single year. Relying on NISA to fund the dividend dream is at best an edge case, but more likely an illusion. It can only ever be a small piece of a much larger and mostly taxable puzzle. The third barrier is more about culture and economics. For decades, many Japanese companies simply didn't prioritize paying back their shareholders. While that's slowly changing, old habits die hard. Unlike the US, where the shareholder is king, many Japanese firms have traditionally focused on stability, employees, and market share, not sending out bigger dividend checks. You could invest in a great, profitable company, but there is no guarantee management will decide to share more of those profits with you. And here's the paradox. Some economists argue that focusing too much on dividend and buybacks might actually be bad for Japan in the long run. It can steer money away from investing in new technologies and innovation and weakens a company's future growth prospect. So, the very thing you want as a dividend investor could hurt the company you're investing in. It's all about balance. On top of that, we have the return of inflation. For the first time in a generation, Japan is seeing price going up. While some wages are rising, your dividend income is fixed. If inflation is running at 3% and probably more this year if you include the price of rice, for example, as we mentioned in this video that you can watch after you finish here. So, with 3% inflation, the 3.7 million yen you plan to live on this year will only have the buying power of about 3.58 million next year, and on and on. Your safe dividend income is shrinking every single year. This puts you in a tough spot. Either you have to save more money in a bigger nest egg, or you have to lower your living standards year after year after year. The final reason most will fail is the most subtle one: opportunity cost. When you focus only on stocks with high dividends, you'll often deliberately ignore the most innovative and fastest growing companies out there. Think about it. Companies like Google and Amazon paid no dividends for most of their incredible growth story. They reinvested every single dollar back in the business to get bigger and better. Their investor didn't get small checks, they got massive increase in their stock prices, a much bigger total return. Many of Japanese most exciting tech and software companies are doing the same thing. They need cash to grow. By filtering them out because they don't pay dividend, you are missing out on some of the biggest potential wins in the market. Chasing a high yield can also be a trap. A stock with a really high dividend is often a red flag. It's the market's way of telling you the company might be in trouble or just mature and not growing anymore, and that the dividend is at risk of being cut. Just looking at the yield without understanding the business behind it is a classic rookie investment mistake. The goal shouldn't be to get the most dividend income. It should be to get the highest total return. That's dividends plus the growth in your stock's value. A portfolio that pays 2% dividend but grows 8% a year is way better than one that pays 4% dividend but only grows 2% a year. Do you agree? So, if the classic dividend-only strategy is a minefield, what are you supposed to do? The answer isn't to give up on dividends, but to get smarter and more balanced. So, I want to ask you, what's your strategy for building wealth in the Japanese market? Are you all in dividends, focused on growth, or you're trying to have a mix of both and a more balanced approach? Please drop your strategy in the comments below. Your ideas might just help someone else to figure out their own path. The dream of just sitting back and living off dividend in Japan is, for most of us, just a dream. The brutal math, the tax trap, a corporate culture that's still finding its way, and the massive opportunity cost of ignoring growth make it a broken strategy for the average person. But that doesn't mean you can't win. The key is to stop chasing yield and start building wealth. That means you need a total return mindset. Build a diversified portfolio that includes those stable dividend-paying companies and innovative growth stocks as well. Use broad market index funds to capture the growth of the entire economy, not just a small income-producing slice of it. Especially when you are young, decades away from retirement, you will always have the time to rebalance toward dividend-paying stocks and funds as you grow older, together with other income-generating financial products or real estate as well. And above all, use your NISA account, max it out, fill it with low-cost funds that are geared for growth and can compound tax-free for decades and decades. It is the single most powerful tool the government has given you and all of us to build wealth. If you enjoyed this video and learned something, please consider giving it a like, subscribing if you haven't done it already. And if you want to dig deeper into Japan and personal finance, please be sure to check these videos as well. Thank you again. And until next time, goodbye.